Manish Gunwani joins in. He's the CIO Equity Investments at Nippon India Mutual Fund. Manish, good to have you on board. And I am going to get in your general view on the equity markets. But why don't we get off by talking about what's happening within the metals basket? No doubt it's a huge negative with respect to this excise duty impact. We were, in fact, interacting with the management of JSPL, who alluded to the fact that they are going to have to bear losses for the orders that have already been signed. Are you writing this space off now?
No, I think it has good value in terms of multiples, in terms of cash flow, even after a cut of maybe 4,000-5,000 rupees per ton. It has reasonable value, but the point is that if you see globally what's happening, governments are definitely stepping in to control inflation. It's not just India specific. We are seeing it happen globally. What does this do is basically, I think, cap multiples of a lot of these core industries, whether it is energy or steel, because in a normal model, you would expect that in a healthy upcycle, they would make enormous profits. But what we are seeing with also state-owned companies in energy upstream, that the market doesn't seem to believe that entire profits will go to the company. And what could potentially be a concern here is that if that kind of thinking percolates to steel as well, then more than the profit downgrade in terms of estimate, you could see also a bit of a derating on the valuation multiple, which could be a bit more medium to long term. So to me, that is probably the bigger concern. Steel margins going down when China opens, it may come back. But the point is, if the governments are trying to, cap the upside on commodities, then you could have a bit of a more structural derating. That's a point to ponder about.
Okay, yes, indeed, it is. We're seeing that really rout play out across some of those metal stocks in trade. But Manish, let's also understand what the undertone of the market is at a time like this. We are gripped with quite a bit of volatility. What's the best way, according to you, for investors in the long haul to cushion against this kind of acute volatility? Because no real sector has been spared the carnage.
Yeah, that is true. Typically, what tends to happen in the second phase of a global economic recovery, where a lot of investors think that a recession is around the corner. Everyone is very nervous. Everyone is very nimble. Everyone's trying to rotate sectors because no one knows whether US will have a soft landing or a hard landing. I guess the only fairly accepted view is that global economy will slow down, especially US and Europe, etc. So no one knows what is the extent of slowdown. Everyone knows last 2 year returns have been healthy. So everyone's trying to protect capital. Everyone's trying to be in sectors which, as you said, are spared the carnage. So we've seen rotation from IT to banks to FMCG. Everyone's trying to find the sector which outperforms. And nowhere is the valuation very cheap. Obviously, after the April 20 bull run, which started in April 20, returns have been healthy. So it's not that any sector is cheap. And the peculiar thing is, unlike last 10 years, this is a correction which is happening in inflation rather than deflation. So if you see since 2010, we've got used to corrections where, FMCG and IT and pharma used to outperform because those were deflationary kind of corrections where commodities used to fall. Leverage companies used to come under question. Now, the difference, I think, is that in a correction in an inflationary scenario where commodities are doing pretty well, interest rates are going up in a stock market correction rather than going down. So the valuation multiples of high price to earning kind of stocks is actually correcting, which means that your traditional defensives like FMCG, etc., don't work all that well. That is what is actually, you know, creating a lot of dilemma in fund managers as to what can protect capital. I think overall, where we are focused on is broadly that the domestic cyclicals seem a better option than global cyclicals because India had a big second wave, and also from a 3 5 year perspective, India went through a lot of mini crises in terms of NBFC crisis, etc. So the base on 3 5 year is also weak. The base on 1 2 years is also weak, and I think if you take performance on a 5 7 year basis, a lot of mid cap banks, NBFCs, autos, cement. A lot of these stocks have not done much, so they're pretty cheap on long term basis of valuation. So I think that is a theme that may protect value. But of course, this this also needs to be calibrated with the fact that if the global economy has a hard landing, then obviously you need to be reviewing this. But as of now, we're going with the belief that since a lot of countries have opened up only in the last 12 months, we're going with the belief that the global economy will still do reasonably okay.
Hi Manish, this is Anisha also joining in the conversation. Well, yes, from dovish and hawkish, now the market mood has moved on to soft landing versus hard landing. Let's see how it really lands. But for now, the market is actually giving up its steam because we have slipped below the 16,300 mark on the Nifty. The Nifty Bank, which had opened up around 0.6%, has also slipped. Now trading with a gain of around 150 points. And if you look at the F&O space, the top 8 losers of the F&O market is coming from the metal space. And deep gashes seen on the likes of Jindal Steel, Tata Steel, NMDC, SAIL, JSW Steel. They're all down 10%, and names like Vedanta, Hindalco as well as Hindustan Copper are also sitting with cuts of around 5 to 7%. However, what is doing well today and one pocket which is standing out is the auto names. So Ashok Leyland, for instance, is up around 6% after it got brokerages upgrade as well. Maruti, M&M are the other counters. Manish, wanted to get your take regarding the auto companies. You said that bet on domestic cyclicals. Would autos be a part of that list then?
Definitely, I think autos, real estate, cement, logistics, capital goods. These are the kind of segments which seem to have a relative value. As I said, you need to be nimble and see that the global cycle doesn't break down totally. But at least there is under ownership here. There is long-term value in terms of if you use normalized earnings or price to book or price to replacement value, that is attractive at this point of time. And sometimes if you go back to the 2002 to 8 cycle, US slowing down can actually be very good for emerging markets, right? Because the key variable for emerging market outperformance is the dollar. Now, if US slows down without hard landing, you could have a situation where the dollar weakens, and that is a big boon for emerging markets. So, in that sense, if that plays out, then EMs in general will do well, and the domestic cyclicals will definitely get a big tailwind of liquidity as well. So, yeah, overall, we think that autos and related segments which are linked to the domestic cycle, they are relatively good risk reward.
Okay, and the inference that one can draw from your answer is also the fact that you would suggest to stay away from export-facing economies and stocks like the IT companies, etc. Would that be a fair assessment?
Yeah, I mean, there is obviously, in terms of valuation multiples, IT stocks are expensive. Maybe as a near-term currency hedge, you can have a bit of that. Because I also feel that while the dollar may weaken, I think the Indian rupee has outperformed a lot of emerging market currencies, and non-dollar developed currencies. So whether it is Korean won or Swiss franc or Japanese yen, they have fallen a lot versus the dollar, whereas Indian rupee has not. Even yuan has fallen recently. So more as a bit of a hedge, but I find it very difficult to make a case for being overweight IT.
Okay, fair enough. Manish, let's also understand your perspective as to what the outlook is when it comes to the entire liquidity situation. Owing to the way we've seen that relentless selling by FIIs, what would you allude the biggest factor to, and what is it that you expect when it comes to the overall liquidity situation going forward?
So, to be honest, I don't expect FI's view to change very quickly. So, I don't think there's one single reason. I think there are two or three big reasons. One is that India has clearly outperformed a lot of big emerging markets like China and earlier the commodity markets like Brazil. Now, clearly, there is a lot more foreign investor interest in a commodity market like Brazil. So you are seeing that India's outperformance over these big emerging markets has been so sharp that foreign investors seem to find more value in the beaten down markets. The second point, as I said, is as much as it is about stock markets, I think it's about the currency. So the same thing holds with the currency that since Indian rupee has outperformed Malaysian ringgit or Korean won or Chinese yuan, whatever commodity importing currency you can think of, I think the Indian rupee has done well. So there is clearly, I think, a bit of nervousness around the currency as well. Um, and thirdly, I think individual stock specific, there are again a lot of bargains globally because India has done pretty well over last 2 years. So people are finding, stocks in Vietnam or Brazil, which have the similar growth profile to Indian stocks, which are uh, quite cheap. Now, given all these reasons, I think it'll be, unless we see, as I said, the dollar weaken, and then maybe the emerging market currencies outperform INR, but INR itself does okay. That is a situation in which I think foreign investors will come back, and you will see positive flows. But until that happens, that the dollar is strong, I just think that relatively to other developing markets, India has just outperformed too much at this point of time.
I wanted you to delve deep into the entire financial space. Where is it within financials that you're finding comfort? Is it just the marquee private banking names? Are you looking at exposure to even the PSU banks? Would you like to venture to insurance, NBFCs?
Actually, we're seeing broadly value across financials. So as far as the lending space goes, for example, now with the steps over the weekend, again, if autos are doing well, there are some very good auto financial names which can be very interesting because obviously if auto volumes do well, their top line will do well, and also credit quality also typically links with the auto cycle. So one is NBFCs, which are specialized in auto financing. I think life insurance stocks tick a lot of boxes. They typically, insurance is a sector which is discretionary in the sense that it grows faster than GDP over the long term because people invest more of their savings as they get rich into insurance. I think it has faced some technical issues because of the big IPO, but I think that should abate. So life insurance looks good. General insurance from a 10-20 year perspective, probably one of the best segments to invest in because of the sheer under penetration. So if you see the size of the Indian general insurance industry versus US or China, you will see that the ratio is almost like 1 is to 15, 1 is to 20, which is probably among the highest you will see in any industry. So just goes to show you how underpenetrated it is. So wherever you can get a decent bargain in general insurance, I think that is interesting as well. Um, Even niche segments like microfinance are turning around and quite positive on that segment as well. So overall, in financials, I think there is value across the space.
Manish, thank you so much for speaking with us today. We'll let you go on that note. Appreciate your time today.